Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyce-No with Kevin Casey, and today we are joined by Jennifer McGuinness. Jennifer, I don't know why your email address is showing up there instead of your name, but just your
No
name, but
idea.
me neither. But there it is. So that's how it goes. Good morning, everyone. It is inflation number week. That's right. Last week was jobs week. Today, or this week, is inflation numbers. So tomorrow we have CPI, and then Thursday we have PPI. Cross your fingers, say a prayer to your favorite deity, and hope for the best, because we know that moves markets. And Jennifer, I wanted to start with you telling us a little bit about yourself, because I don't think I could properly introduce you and speak to the many things that you have done and accomplished over the years. So give us a little synopsis.
Yeah, so whether I like to admit it out loud or not, next year will be my 30th year in the industry. And when I first started in the business, I started on what I call the happy side of origination, originating mortgage loans, underwriting, processing, etc. Then I went into legal, then a national footprint for real estate-based litigation law firm that did the not so happy side of lending, foreclosures, bankruptcies, REOs, and a vast array of other complex litigation, both debt and equity related for resi and commercial, small balance commercial. Then went into servicing, built, ran, and eventually sold in concert with the business partners a servicer that was an acquisitions business. And candidly, we bought really hairy scratch and dent loans, fixed them, and either liquidated them or securitized the assets. I've been in both the buy and the sell side in the investment banks, most recently at Deutsche Bank, overseeing, large components of the residential mortgage-backed securities book, whole loan and mini bulk acquisitions and servicing related items. Then I went into hedge funds. I helped build and run the first hedge fund to ever issue resi mortgage-backed securities with a AAA rating, collateralized by newly originated loans. Why is that important? Nobody had done it with short duration capital, and that brought additional liquidity to lenders so we could originate more loans. Until that point, hedge funds had only really done reperforming deals or real aged assets, so it was new origination. And then I moved on to Colony and entered more of the single family rental realm, working on DSCR, bridge, fix and flip, etc. And then fast forward to today, I actually own the first woman-owned aggregator of non-agency products. We're also a diligence company. I have a loss mitigation optimization group where we oversee loans for ourselves and third parties, as well as a breach defense, repurchase, indemnification, etc. Group that works side by side with lenders, litigation support group, and an expert team. Sounds like a lot of things, but all it is we actually built an operating company that can handle origination, post-origination, all the way through liquidation, and all the things that, quite frankly, go right and wrong in between. And I did that, but I got sick of building multi-billion-dollar trades, sitting in all those Wall Street roles, because that's what we do on Wall Street. I'll probably get yelled at by some of my Wall Street people if they see this, but that's what we do. We raise capital, we hire a bunch of third parties, we oversee them as much as we can with the skinny team internally. And when the trade's over, it's over. I wanted a business that could proactively react to market change, and that's what we built here.
That's it? That's all you've done? I mean,
That's it.
Kevin, I just want to apologize to everyone for bringing someone on who has very little background, not a lot of experience in the industry, and
I'm a
probably not a whole lot
delinquent.
to add to the conversation. Jeez Louise, Jennifer. I mean, probably the list of what you haven't done in the industry is shorter. So that is something else. Okay, so I don't always do this with people, but I wanted to with you because again, it's astonishing, really, in 30 years what you've done. So, to say that she has an extensive background would be a massive understatement. So, moving right along, good Lord. There are a couple things I wanted to let you know about. First of all, and Jennifer, I hope this doesn't impress you too much, and knock you off your game, but I just wanted everyone to know that I have been invited to be a part of the Illuminati. I got an invitation, and they base that. I don't know why you're laughing. They've identified me as a candidate with exceptional manual dexterity, because that's very obvious in everything I do and say, academic proficiency, and we believe you possess the potential for their exclusive community. So we can, oh my God, I was so excited about that. What do you think? Yeah,
I have no
exactly.
idea.
Exactly. Okay, so talk about the latest scam, right? Like, I mean, who lunch this kind of crap. But anyway, I thought it was funny because I'm like, wait a second, am I having like an angels and demons experience? What, like, can I be in a
I
movie
was
now?
disappointed I didn't get invited. Huh? What the heck?
Listen, you apparently have not demonstrated manual dexterity to the extent that they want to invite you into their special little club. So,
Oh,
uh,
wow.
I mean,
I'll,
are we supposed to do like the itsy bitsy spider or something? Like,
oh, that's a great idea. God. Anyway, all right. So now that I've dazzled you with that, we will move it right along. So, oil, we're at $82 a barrel about this morning. At last I checked, we were in the green on mortgage backed securities, but God knows that's a moving target. I guess we're up 4 basis points right now. It's sort of been bumping along a little bit this morning, and it is so far hanging in there. The idea is if we can get a decent CPI report tomorrow, and in theory, a good PPI report on Thursday, maybe we can get some traction. We certainly have had a bunch of crap job reports, including but not limited to the ADP weekly, which came in at 8,000 jobs created, which would be 35,000 a month. But last, I think Friday, we got BLS, my very favorite, as everybody knows, for July. And you ready, folks? They were estimating we'd have 80,000 jobs creations, but instead, what we get? 23,000 job down 23,000. Geez Louise, I almost the unemployment rate went down, but the excitement around that should be tempered considering we've lost 1 million people in the labor force in the last 2 months. And we had Ron Hetrick on last week. He's a labor economist. He used to, and Kevin, we went 13 rounds on what his actual position was at BLS. He supervised, he ran, he did something. Anyway, he was in charge of the department at BLS that generates the jobs report. So he's able to shed some light and clarity on how it's all done. And with all that, though, that was a while ago. And so we are still getting massive revisions. So we had revisions of 103,000 less jobs in the last 2 months than were originally reported. And what's disturbing about that to me is that the market still reacts to these numbers. So in May, they said that we had 172,000 job creations. That looked fantastic. The market went crazy. They were not happy. At the end of the day, after all the revisions over the last 2 months, we're down to 63 job creations in May versus the 172 originally reported. June, 57,000 down to 20,000. We have one more revision coming. So we'll see what that ends up looking like. But Jennifer, you're Miss Market. Why do the markets respond to these reports that have such a long history of being complete garbage and are going to have massive revisions down the road? Why can we stop it? Can you stop it?
because that's the analytical data that our markets have decided to use. And one of the things I've actually cautioned about, I've actually written about it, is how big the revisions are for things like CPI. But with the new CPI print coming out, I am concerned about the fact that the last print was based on when the MOU on Iran, was technically in place, however long everybody thinks that actually lasted. And that, right as the last one came out and we were segueing forward, obviously that, ceasefire, died and failed, right? So one of the things I said when the last print came out is, are we going to see a boomerang effect right back to where we were, or even maybe a little bit different, and I think that's what I'm watching for, as this next one comes out. Are we just going to see a bounce back right up? I mean, I think the Fed used the last CPI print and a couple of other things to keep rates, static. My concern is if we have a boomerang effect that, we actually end up with a possible rate increase or a higher probability of an increase.
So, Jen, I proposed recently, maybe even as recently as last week, that we've been following the Iran conflict and the ups and downs of that, and we have decided we're going to turn it into a drinking game. And every time somebody says that there is a proposed ceasefire or a ceasefire has been reached or some sort of agreement has been reached, we are all going to take a shot. So it is I'm just over it.
Like there are a lot of drunk individuals because there's a lot of conversations of, oh, we're in negotiations. The US will say that. Then Iran will go, no, we're not. Right.
Right.
So there's a lot of, ADHD, shiny ball chasing headline stuff going on. And, one of my favorite lines is details, not headlines, right? And until such time that we see some sort of real documentation where, they're both agreeing of what's going on, I just don't see how anybody can rely on it.
No,
I do
it's so
think
all
that there
Well,
are, strategically placed headlines, um, purposely,
you know what,
that make the
how I
market
judge it,
move.
I've
Sorry?
been noticing a very steady gas price at my local corner gas station. It hasn't moved off, and I know you're going to be shocked by this in Michigan, but 5.65 for unleaded gas, the standard kind. Um, and it's been that way now for a good 4 weeks steady. So that to me is a good sign that even though all the headlines and stuff are going all over the place, the price has been steady, which is to me that means it's market steady.
I'm
And if
over
you
six
drive
bucks a
past,
gallon. So I am not happy. Steady is not working for me. And Peter made the comment, you will end up more bombed than the Strait of Hormuz, which was
oh
awesome.
geez.
That is fantastic. Thank you, Peter. We all needed that. What were you going to say, Jen?
No, I was gonna say, I think with regard to our gas prices remaining steady, I think you want to drive past gas stations at least around 3 exits from where you live and see what the dispersion really is if you don't want to rely on barrel prices. I think the other thing is the market's generally driven by Brent crude itself, right? So watching that, depending upon timing, can get differentiated fluctuation.
Well, we also know that it takes a while for the price to circulate its way through the market, and so oil was with West Texas this morning was at 82 bucks a barrel or so.
I want to go to Texas where it's 3.59 a gallon. That's definitely not the price here in Michigan.
Well, we were in Texas in I don't know in the last fall, and it was 250 a gallon. So if it's still only 350 a gallon, God bless them, because that is yeah. Again, in California we're paying insane gas
I think one of
prices.
the most interesting headlines I saw in the last couple of weeks was Trump making a statement that the oil and gas company should give them part of the windfall profits for, barrels going to such a high level price. And the addition, and when you look at the earnings reports of the gas companies, et cetera, I'd like to see them attempt to collect that. But my point is you are seeing headlines like that as well.
Okay, so we have Bill in Texas is saying $3.59 a gallon there. You know what, Bill? God bless you. Now, I would like to point out, Bill, we'd like to compare our humidity and our temperature right now and see which one wins on that note.
I don't know. I'm gonna have to go Team Bill on this one. I used to live in Texas. The humidity in comparison to other areas is not that bad.
Well, okay, you're in Michigan. You don't even get to
Yeah.
comment. We have no humidity. Someone said Dallas has the Cowboys, but no ocean. We have
We
the
have lakes
49ers
though in
and an
Dallas.
ocean.
There are
What?
lakes. Anyway.
Oh my God. We have an ocean. We have everything here, except we do have very high gas prices. That is faux show.
Yeah.
Okay. So moving right along. NAR came out with their existing home sales for July, which is closing on existing homes, which on the surface wasn't fantastic, down 1.7% month over month, but the annualized pace of 4.06 million units was slightly better than expected, although very stable. The markets are looking for 5 million units a year. Is that reasonable, Jen? I mean, are we going to get there? Because we have not, I don't even know. Have we ever been there? That's a lot of units
I'm going to get
compared to where we
myself in
are.
trouble with my next statement, I'm sure, on this call, but stop keeping people in their homes with HELOCs and closed end seconds, and we'll get more property on the market.
Okay, let's just go there. Okay, so Jen is on a mission to she's beating the drum that we should not be pushing HELOCs and closed in seconds. So why don't you expound on that, Jen, and let us know what your thoughts are and and tell us how everyone else is reacting in the industry.
Nationally, we sit in one of the highest equity earned scenarios that the markets have ever sat in. And yes, there are some markets that have plateaued or slightly softened, but we're going to leave that aside for a moment. For the properties that actually have first mortgages on them, that have this record level equity, I don't know about you guys, but how many times a day do you hear, I hate my house, I love my rate? And that the borrowers want to be able to keep those 3 and 4 handle rates of yesteryear. Well, that's great, but when you start putting them in with an 8, 9, 10, depending upon credit profile, second lien HELOC, closed end second, or even higher rate, you actually do the math on that, the average blended rate is not actually that much off from where our interest rates are today, or are at least fluctuating to pretty regularly at the moment. So wouldn't you be actually better off if the borrower wants to stay in the home and they still want to have that tap of equity, give them a first lien HELOC. If they don't want to stay in the home because, to my point, they hate the house, they love their rate, right? It's better for you to educate them that that equity today is cash. And that cash, when the home is sold, can be used for the down payment and, if they want to, rate buy down on a new mortgage. Also, lender friends, you can get 2 mortgages out of every education that you give to these borrowers that believe they're locked in based on that first lien rate. Why? House is going to get sold. Realtor relationships, leverage them, become the preferred lender for the sale of the house with the realtor that's selling it. With regard to the acquisition of the current inhabitant that's selling the house, you also get their loan for the new purchase, right? How many lenders don't like the idea of 2 first mortgages on an X premium price versus 1 second lien closed end that's now going to actually keep that borrower, because of the leverage scenario, in that house longer? Part of our supply demand, I don't want to talk about, 9,000 different homes that we need to build, depending upon who you talk to, it's 1 to 7.5 million houses. It's a lot lower than 7.5 million. It's more than 1 million. But in order to do that, right, you'd be better off getting that supply demand moving in the markets that you serve instead of it staying stagnant.
So Jennifer and I were having this conversation yesterday, and when we have 46% of the houses in America have no mortgage at all. So she's speaking to the places that do have a mortgage, and
very
because I
specifically.
and so it's important to make that distinction, because otherwise I start arguing, but we need to get rid of the capital, or we need to up the capital gains exemption, because it's keeping people, definitely in my area,
There's a
in
bill
their
right now.
homes much, because it is so much more expensive for them to sell and relocate. A lot of them don't have mortgages, so they don't fall under Jennifer's idea. But it's funny with the HELOC closed in second thing, because without that right now, I think we would have I think our market would be more frozen than it is in terms of lending. And
Yep.
I think that people would be, and we've been preaching blended rate forever. Make sure you're doing math before you do anything for a borrower. But we are not the only people doing HELOCs. And I bet you $1 million, anyone, like most of the banks out there, they're not doing blended rate. Someone comes in and says, I want a HELOC. They're like, okay, here it is. Right.
Right, but the question is that what your borrower really wants, right? They want to be stuck in the house. I agree with you, the no mortgage on the house, capital gains assessment, and a vast array of other things can be a gate for those borrowers deciding to move or transition. But on the mortgage side of things, and I agree, Peter, that you can also use HELOC proceeds or second lien proceeds to pay off consumer debt, some tax deductions and things like that. But again, what is the borrower saying? Are they saying this is the house I want to be in or not?
Yep.
Right? What do they want to use? You have to listen to what the borrower is asking you for too, not just say, oh, okay, you hate your house, sure, I'll give you the second lien. If you hate your house, here's other options. Let's explore them all. And I do agree, Jill, I see your comment as well, doing the blended rate assessment, etc. I don't think it's only explaining the blended rate. I think it's also explaining that before you do a second lien or a HELOC, converting that equity into debt that would be cash upon liquidation, that cash actually has purchasing power and also rate, reduction power as well. So I don't think it's only a blended rate analysis. I also think it's what is the purchase power or the power that that equity in cash can bring you. And then 100% agree with Jenny. I agree they should increase the capital gains amount, especially for certain states. I mean, it's just illogical that they haven't. And based on that, they should just do it nationally, seeing as it's federal anyway. But at the end of
Yeah.
the day, it's not just calculate a blended rate. It's also, hello, borrower, what do you really want to do? Do you like the house that you're in? Is this your dream home? Are you planning to stay there? Because nobody likes to talk about what's about to come out of my mouth. Most mortgages, whether it's 30 or 40 year, generally only last 7 to 11 years on average. That's it. Okay, so if you have somebody, for example, that's relocating and only going to be somewhere for work for 3 years, it doesn't pay to worry about getting a 30-year fixed rate to begin with, right? They're never going to get to a place where they're going to pay down enough of that principal balance to bother. So again, product and payment structure can really be an optimizer for the borrowers. And yes, I'm going to use the words lots of people don't like to talk about anymore. Interest only loan for that 3-year borrower would actually be their best bet from a payment perspective. For the guy that hates their house and they have significant equity, be their resource. And you want to talk about recapture? The person that trains a borrower how to make their life better is the one they're going to remember forever.
100%. Okay, so you don't have to worry about interest only when you're talking to us. It's the regulators who don't want to see that on an owner occupied property. So I don't know how we get around that anytime
The
soon.
IO loan on an owner occupied property is not actually the problem. They're really more focused on making sure that there's no capitalization or negative amortization. So the floating rate coupled with the IO tends to be the bigger issue than a standard ARM IO structure.
I mean, we were
The
both big fans of negative amortization on rental properties back in the day. It was a huge benefit for property owners.
Well, the people on this call in the audience understand, for example, some of the loan products that people like to vilify really were not villains. They were created to serve specific borrowers. For example, the option arm was created to serve a specific customer. It was when they started being given to everybody that they became
right.
an issue. But, product structure actually is beneficial to assist your customers. I'm sure everybody here agrees.
We've often referred back to the world savings loans where you were self-employed, you put down 20%, you had an adjustable, it was based on coffee, which was a really stable index with real, and the margins were really great. So there were people in those loans that were really happy for a very, very long time.
Very long
And
time.
this was really before credit scores were even something, they weren't even a thing we were using. So that was a really good loan. And so you're right. But then, again, these Wall Street guys got a hold of it. And all of a sudden we've got, 8 quadrillion% on the LTVs, and we have margins through the roof. And then it all goes to, well, we know where it went. So anyway, it is, there is no one size fits all when it comes to mortgage lending. It's so individual. And that's what a lot of these regulators and a lot of the people who aren't working with borrowers every day completely have, they have no sense of it at all. And so that's why every time I hear, the data aggregators, I'm like, okay, but, I could tell you 50 different scenarios where that doesn't apply.
100%.
And that
Yeah.
matters. It should matter. It should
Yeah.
matter. So it's a little tricky.
Well, I mean, I spent a ton of time in DC during the housing crisis, and I'm still in DC pretty regularly. I think the most frustrating component of being in DC during the housing crisis was the most of the people that were selected to assist in coming up with a lot of this regulatory that's now in play had never been involved in the mortgage industry a day in their lives. Most of them also not real estate. I think one of the things, Audrey, you and I have talked about is Rohit Chopra at that point had never owned a home, right?
God.
And you're putting someone, overseeing and collecting from mortgage companies that never actually had a mortgage experience, and that's just not reasonable, right?
It's
There needs to
insane.
be real experts involved. I said this, we're talking about rates, right? So the Fed now under Warsh is creating, the 5 groups for research, right? The committees. Well, you look at those committees, there's a lot of really smart people, but they absolutely have never taken part in the markets that they are involved or are being asked to research. There needs to be, for mortgage, real estate, financing, debt, all kinds of lending, personal loans, etc. They need to have voices from the actual markets that have been here through multiple cycles, or we're just going to end up in another rhetorical place of needing to change things over and over again. And it'd be great to right size the markets, keep it consistent so that it's not going through some of the, ebbs and flows that we've experienced since then.
Yeah, and the really sad part of all that is that the people who, like us, the LOs who are on the ground working with the borrowers day in and day out, we hear a zillion different scenarios. We talk to people and know what their lives are really like. We're only valued for our volume. We're not for our brains, not for what we know, what we experience, what we can relay from the ground, from the borrowers, the end user of all of these ideas and rules and all the regulatory changes and all the guidelines. We're the voice for that, but our voice is really muffled because again, the only value we have is how many loans did you close and how much money did you make for my company. So it is frustrating on our end for some of us. Some of us don't give a crap, but a lot of us do.
For the ones that are
So
making lots of volume, they don't care.
they don't care that because they're not, because we've lost focus of the borrower. I mean, the industry has just moved to it's money, quarterly earnings. What's my IPO going to look like? What do I tell my investors? It's frustrating for me personally. So
Hey,
I'm sorry. What were you going to say, Kevin? My apologies.
I was going to roll back to the capital gain tax. There is a bill I saw in the House. I don't know how much traction it's getting. It's a little bit limited, but it would increase the capital gains limit for home sales to $1 million. But one of the requirements was that the homeowners had to own the house for 25 years or more, which kind of knocks off a lot of people on that.
Which is such a diamond. Like I mean, it's not the norm anymore, right?
Yeah.
I just told you 7 to 11 years on average. You'll occasionally have the tertiary borrower that stays in the home and actually pays off the loan, but definitely not as much as it used to. But I mean, you have to think about the differentiation, throwback to 60s, 70s, etc. The starter home today is not the starter home of then, right?
No, not at all.
Our starter home today is like their end home or mid-stage home, right? The
Yep.
price point's very different, the size of the home's very different,
Yes.
the structures are very different. So I mean, I think the requirements of the administration, regulatory, etc., needs to realize what year we live in, right?
Yep.
I think again, throwback to the 60s, women have evolved significantly over time. If you look at the ratio of single women owning homes, it is drastically different.
Yes.
And there's a lot of different evolution that comes with that, right? So that education is necessary. One of the things I said in the vast array of roundtables of regulation that I was involved with was they wanted to do all these different regulations that we all have to do the Rubik's Cube of interesting to achieve, right? Well, if they just went to net pay, and I mean take home pay for the underwrite instead of gross and all the other different gymnastics that we need to do to underwrite these loans, you really don't need ability to repay. If they have enough money, they have enough money. If they don't, they don't, right? And then you're in a very different, situation. Now, the feedback at the time that I was given is, oh, no, that'd be too difficult to figure out. We have the document. It's not difficult at all. But again, I think it speaks to who's involved in making regulation or legislation and, what the reality is of what we do all day.
Well, two things. Number one, I'm glad that when you're talking about affordability, you're also talking about the difference in the homes today versus back in the day, because they are vastly different. And so when we're saying, oh, a home isn't affordable, well, you're not looking at a 2-bedroom, 1-bathroom home, which is what your parents might have been buying as their starter home.
Yep.
Without granite countertops, without all the bells and whistles, no air conditioning. So again, you can't compare those two homes and think it's the same and think that we are doing affordability. And we have a big problem now. If you go to buy that house today, you can probably afford it, right? I
There's
mean, and
actually
again,
not even enough of those homes for the demand of home ownership today,
there may not be,
right?
but what they're building instead is condos, which don't even get me started. So the other
Oh, you
thing
mean the condo revision that's not gonna help first-time home buyers anymore at all? Let's use that one. But look, I think you're right, right? I think there's a lot of challenges that are presented today that didn't exist back then, and comparing those apples to today's oranges don't make sense, but everybody does it.
yeah, the other thing too is when we're looking at income, part of our issue is that there are often income sources we're not allowed to use. So, okay, you have a job, you have two jobs, but you haven't had that second job for 2 years. Okay, that doesn't mean that you can't keep a second job. It doesn't mean that that income doesn't count. I mean, if somebody has a second job and they buy a house and they need the income to make their payment, they're not quitting the second job. And so we have, and then you have somebody else living in the house and they are contributing towards the income, or you have a roommate. You can't count roommate income on a lot of loan programs. There's so many times, or you're a gig worker and you can't count blah, blah, blah. You get my point. So the whole idea that we have, and it's funny because I know you interviewed Sandra Thompson, but I spoke to her when I was in DC one time when the whole conversation around whether or not there should be another hit to pricing if you had a DTI over 40%. And there were lots and lots of studies or studies, that's probably a strong word, but there was a lot of evidence that the DTI was not the driver in delinquencies. Like that was not a good indicator of whether someone would default or not. And so I had a brief conversation with her about that. And I said, that is not the issue. And especially, again, like when I'm looking at a loan file and I have a DTI of 47%, that is not a single person with no other source of income. I mean, I'm not going to put that file through.
Yeah,
I'm
but
not
you
going to
also
do
have
that.
to remember, and this is something I recently really focused on. I even did a post about it on LinkedIn. I actually called for an LLPA and a G fee reduction, right? And I was like, this has to stop. The fact that, we're getting charged multiple times for the same thing, i.e., having to pass through most of that to the borrower, is just completely illogical, right? So, you gotta eliminate repetitive risk stacking on that, cumulative charges for multiple characteristics. Measuring the same risk does not make sense, right? It's not a one size fits all, right? First loss protection. What's amazing is when they create these, they don't even consider MI protection, CRT being sold for additional first loss risk, etc. So you're paying full bore on what they believe, and the rate is paying and the price is being charged full bore of what they think the risk is, but yet there's multidimensional, revenue streams that are actually protected. Call it 25% MI really protects them from 25% of what they're concerned about. Also, credit pricing from policy pricing, they're not transparent as to what goes where. 10 basis points goes to the federal government to begin with off of some of these fees, and nobody actually spells that out for you. And the use through the cycle data, they shouldn't be automatically rise because macro capital adjustments assume home prices decline, right? They actually assume that markets are declining when equity is increasing like this. It's just not okay. So there needs to be some sort of cap on combined LLPAs. They should have reasonable ceilings. It's and that's not opening the taxpayer up to additional risk. That's
No,
called getting back to reality, right? The
right.
GSEs were not created, for example, to be the cash cow that they are today, right? But
It
now that they are, the government likes to keep them that way. But quite honestly, they have enough cash cow without these additional hits that we're seeing that have risen to a ridiculous level.
So this has been a drum I've beaten for so many years. It's not even funny. And yet nobody listens. So when the government is saying, oh my God, we have an affordability crisis. Oh, we're so concerned. Yet they're charging egregious LLPAs and G fees. It is insane. So and to your point, layering, oh my God, it pisses me off so much. I mean, really. And especially, okay, you're doing a cash out refinance and your LTV is 20% and you're still getting a hit with an LLPA, show me this is not risk-based pricing. This is we want more money pricing because there's
Uh-huh.
no way that there is any study, any data anywhere that tells me that a 20% cash out refinance is more risky than an 80% purchase. With that being said, you specifically in your post on LinkedIn proposed that we have a 17.9% reduction in the average GFE LLPA. Why did you how did you get to that number, and why that number?
That's actually 17.5 to the G fee alone. And then
Ah,
what we
well,
need to
not
do
even
is
the
actually,
LLPA.
yeah, so the LLPA drivers are in the list below that. So the things that have to actually be right sized. So you need to take out the additional stacking of the additional risk profiles, et cetera. So if you go to the bottom, the 17.5% was actually taking the average G fee last reported and reducing it to 53.5 instead of 65 basis points. So that's your 17.9% reduction. Why am I
Okay,
calling for that versus, what it really should be, which is a lower number than that? You have to start somewhere. They're never
yeah,
going to bring it to the level that it really should be at on the first go
yep,
round. But getting, alleviated in a reasonable percentage, you're talking about, 10 to 14 basis points right there versus what was last reported, which was 65. And, generally the GFE on average is somewhere between 61 to 65, right? So what I would say on the higher end is where we've lived for quite some time. So what I would say is we have to start somewhere, right? The rock with the
okay,
chisel and get that done and then move to the next one. But really getting that multi-stacking tier credit for risk offset, CRTs, stacker, MI, etc., needs to happen. And it needs to
yep.
happen now.
So I've argued with the GSEs multiple times, saying as they are telling me, "Oh, it's risk-based pricing." I'm like, "You're full of crap. Show me,
Guys, this is
show
really
me."
simple. Just get the people that vote for them to make this the number one issue that they are focused on, right? For example, the investor owning too many, properties as rentals. One of the reasons that was such a big deal in Road to Housing, it was one of the top two bold issues from voters, right? And when you go to DC, they will look at you and say, you'll tell them this is really not going to make a big impact. And
Yep.
they look at you and say it was top two polling items. When we make affordability and get that affordability to that top two, if you don't bring me this, I'm not going to vote for you. Everybody will start paying attention.
Okay, but then the next question becomes, and it should with all data, how many people did you pull? Who did you pull? When did you pull them? So, you know what I mean? Like, okay,
Agreed. I mean,
really?
if you're only, looking and polling 1,000 people in New York City, throw it in the trash, right? So yes,
Exactly.
I agree. Percent polled versus actual geo is extremely important. But again, you get that message loud enough throughout the nation, right? President of the United
Yeah.
States will focus on it.
Well, but the other thing too is that if you're polling the constituents, their understanding of these issues is minimal. So they're not going to actually understand what they're being asked or have an answer that may or may not be worth. But to your point, it's all about who's going to vote for me, right? So
But it
you're
also starts with the boots on the ground, right? Borrower education and understanding mortgages has not been a number one priority, right? The
no,
more you
no.
educate borrowers on purchasing power, refinanceability, what could I use my house to assist me with that I'm trying to achieve, et cetera, then they start to understand that one of their biggest asset really can work for them, not against them. And then when they start looking at, well, why am I paying this much more? I got a 760, FICO score and, a 50 LTV, but it
Yeah.
happens to be a condo, so I get hit for condo. Unless it's a high risk condo, low capitalized condo, we should not have the same condo hit. There's another example, right? So, we rational thought process, and I'm going to say it again, with real experts from our industry, those are the discussions that have to take place, not just the make some headlines with 500 people audited or, polled, to your point, Audrey.
Okay, so there were like three things in there that I want to touch on quickly. So you had posted about the road to housing, and your comment was the legislation is not going to move the affordability needle today, and it does not solve the immediate problems facing home buyers. What it does do is provide a blueprint for concepts that now have to be funded, structured, and implemented, and that much of that has been dumped on HUD and FHA to do most of the different activities, yet their workforce reduction has been significant, and there's a 24% cut to their budget in 2026. So,
All true.
well, I this is directly quoting you, my dear. So,
Right.
so we
We were
assume you
literally
were
given
telling truth.
35 new jobs,
What?
35 different things in the road to housing with 24% less budget and significantly less people.
So it's funny because when I have questioned, and I am curious, I'm always curious, right? So I never have this idea, oh, I figured everything out, I know everything. I'm always like, okay, let me learn something else. So when I have questioned this road to housing, whether it's with lenders or with realtors, I get shot down so fast. And it's like they have just jumped on the bandwagon and the narrative, and they're just accepting it. And this is great. And other than we finally got our legislators on both sides of the aisle to agree on something, I'm like, okay, I kept saying how is this going to help? Who's going to do it? How is it going to get implemented so it touches the borrowers? And now we
I
have
will
you saying,
volunteer. Bring me all of the pitches that you're getting from the realtors and whatnot that are saying this is so great that you keep trying to address. I will volunteer to help you put together the documentation to educate them on beyond.
God bless you, my child. God bless you. Okay, so you have advocated for having HOA fees escrowed,
Yes.
and you so walk us through that. Let's start there.
So in most states, HOA, delinquent HOA charges can be converted to liens, liens that could take super priority to the first mortgage, and
Right.
therefore, foreclose out the first mortgage. Obviously, if the HOA fees were less than the full proceeds from that foreclosure, any surplus would go to the first or second lien holder. But it does not make sense in the cost of, the compounding late fees, interest, etc., from these HOAs that, this isn't being managed by servicers. The servicers should really be managing.
So I
HOA
think
fees are still taken into consideration in DTI calculations. So my whole thing is, why aren't they part of the loan when we're doing an escrowed loan with taxes and insurance?
it's
I've always
because they're
wondered
due
that.
monthly and not due yearly or semi-annually. And so I think, I'm guessing, this is my guess. You can tell me because you have more insight into this. I'm guessing from a servicing perspective, it's probably a heavier lift, although we could change how billing is done on
Aren't
HOAs.
we in the tech world, Audrey? Nothing is a challenge with tech. I'm sorry. But
Stupid me.
But
my
whether
point is this is not as difficult to do as it has been historically,
Yeah.
based upon, a lot of things that have been done to allow for customized fields, reporting, outsource oversight, etc., at the servicing level. The servicers generally just don't make really good margins on servicing loans in general. So, servicers don't really want to do more for less. Not that their fees would go down, but the holder of the loans are not generally going to want to pay them more. I think one of the biggest misnomers in the market is let's just use a generic servicing strip, is somewhere between 25 to 50 basis points, but let's stick with 25. The
Mhm.
servicers are not really getting paid the 25 unless they're the owner of the servicing and the servicer itself, right?
Mm.
So most of the time, those servicing rights are owned by guys that don't service for themselves, and then they employ a sub-servicer. The
Right, right.
sub-servicer is getting a small portion of that 25 basis points. So it's really has been something that's been pushed back on by the servicers saying, we just don't have the capacity in our systems and structure to do this. Well, they do today. If they can administer complex loans, they can easily manage escrow advances.
I
So
think this
I would be a fan of, for certain borrowers at least. I mean, some people really don't want or need their HOAs to be escrowed. However, I think another issue that is so obvious and is become a monster problem is we need HOA oversight because they're so badly managed and mismanaged, and And Kevin and I hear stories, every person listening to this today who has borrowers who have bought or sold condos, they're a disaster, and the HOAs are the problem. And so I was just talking to someone yesterday who is lives in an HOA, and there's this one woman who has managed to control the whole thing, and she is just guiding them to do the wrong thing. So they've got huge issues. And then you made the point in your post that in California we have SB 326, and that is definitely it's really compounded things, because you've got all these places who should have done an inspection, or maybe they did do an inspection, but they still have no plan, no money, and nobody wants their HOAs to go up. So it is, and a lot of people, it's shocking how many people I speak to who had no concept that their homeowners association dues could ever go up. They don't understand the
Again,
the
borrower
maintenance. They don't get
education,
it. And so
right?
when you've got the property taxes, you've got not property taxes, when you have insurance costs that have skyrocketed, you have this deferred maintenance that is now rearing its ugly head, and they're having to deal with it. And then again, we haven't even had the reserve requirements hit yet, which it is. So when they're building all these new condos, okay, those will be fine for a while, but eventually they too will have maintenance that needs to be done. And so it is complicated. And again, we have legislators, people who are regulating this idea, and it's a mess. It's a mess.
Well, remember that there are certain exceptions to the new 15%, right? So buildings 10 or less units, etc. But what the GSEs could have done was they could have done something a little bit more thoughtful than just, hitting, the reserve requirement being higher and certain other things. They could have actually said, let's solve for, does the HOA have a property manager? Yes, no. Does the HOA bum 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 bum? That would actually get rid of Betty Smith, who volunteers to be the head of the HOA for 30 years, for example. And it would actually be an easier bar to achieve for a homeowners association that would be more fair for midline condos than some of what's just been put in place. The other thing is, remember that the cause and effect to why HOA fees go up, right, is also coming from that tax and insurance increase, right? It's a different holding. So we also have to get to a place where we get to some level of a national structure to decide on how insurance companies are going to assess risk, right? For example, I mean, for those that are in California, you know this. The modeling allowance for California without a special approval was that for many, many years, they could not actually model into the insurance risk fires,
Right.
flooding, significant other things that started happening in California. So a lot of the reason why you've seen such an attrition, Florida as well, that you've seen such an attrition in costs for, insurance go up now nationally is actually because the insurance companies also didn't have a choice but to get the money that they're losing somewhere else where they're restricted by regulation without, special approvals. They need to get the money back somewhere. So they're getting it from everybody else. So there's a cause and effect. If we can get that reined in, the manner in which insurance, risk is calculated, thresholds by which taxing authorities and insurance companies can't raise costs by more than X on an annual basis or Y in a 36-month period, things that are reasonable for borrowers, consumers to deal with and understand, then we'd be in a much better place. But right now we have way too much going on at the state level that at times is contradictory to federal, or quite frankly, there is no federal to actually address it or, provide some substance to standardize too.
So a couple of weeks ago, we were at a conference, and I had the opportunity to interview one of the two finalists for California State Insurance Commissioner, and we had a really, really good conversation. And I floated the suggestion to him and told him to please feel free to adopt it as his own, that if he is elected, which I hope he is, that he work with other state insurance commissioners across the country, because although I don't necessarily think that it's a good idea to have the state or federal governments running insurance, we do need to have a collective coming together. I guess that's redundant, but you get my point. Of we need to come together as a country, and we have insurance issues across the country. So you might not be in wildfire zone, but you might be in hail zone or tornado or hurricane
Uh,
or floods, or, we're
earthquake.
seeing this across the country in places that you wouldn't normally think. So it is something that needs to be addressed for sure. But back to the HOAs, we have there. I think that having a property manager could help, but there is an association where I live in Walnut Creek, California, that is so bad. I will not let my clients buy in there, period. I have literally bullied realtor friends who've owned in there into selling, and their association is so mismanaged that the entire career that I have had in this area of almost 37 years, they have been in litigation most of it. And usually not just one thing, but multiple
Multiple.
things, because they cannot pull it together to save their life. So now these condos are super cheap, but the HOAs are like $1,000 a month for a 1 or 2 bedroom place. I mean, anyway,
Yeah.
so yeah, it's
That's the one
complicated, and
little
the HOAs
caveat
don't
about.
want to be they don't want to be regulated at all. So anyway, go ahead, Kevin. Sorry.
I was gonna say the one caveat about having HOAs impounded is that it's a timing thing because if you let's say your HOA fee is $350 a month and the lender pays the $350 a month to the HOA, but then suddenly they get a notice that now we're raising it to $450, but the borrower does not forward that on to the lender, then the lender is going to make a $350 payment and
Well, just like, yeah, but just like taxes and insurance that get increased as well. The servicer then does an escrow analysis to adjust the payment on the loan. They pay the actual amount that's due. And then the borrower makes them hold the difference, right? And that could be done in incremental amounts or in one payment.
I think that's got some hair on it too. And but I totally get it. Like, we got
same
to do
thing.
something. It's
Special
just
assessments would be another problem.
huge
On
problem.
this escrow.
Yeah,
Huge.
and you know what though, if most of these HOAs were better managed, there'd be many less special assessments,
That
right?
Right.
would be true.
So what ends up happening is they kick the can down the road and then it comes to a catastrophic or a serious issue and now they have no choice. And when they have no choice or the roof starts caving in, they're also subject to pricing that, has an additional risk layer priced into it, right? Which is how
Yeah.
those special assessments also become that much more expensive.
I think the other two is the size of the HOA. Small, like a 2 unit building that got converted to condos, that obviously could be run by the owners, even, 4 units, up to 10, then it's, you probably don't need a big homeowner association, but I think anything over 10 units probably would require or should require a management system in there.
Well, if
Uh,
you look at Ginny's comment over here, in my county, the tax collector assessor was 4 years behind on
yeah,
supplemental tax bills. There's a way to fix that. If you tax collector do not get the bills out within 3 months, 6 months, come up with something. In the timeline in which you are supposed to get them out, you'll never collect the money,
I
right?
love
And
that
watch
idea.
how quickly they stop falling behind by 4 years.
No government's going to ever agree to that. And actually, a few months ago,
Let's get that proposition done.
we were surprised to find out that, so in California, we have Prop 13. So when the values were going through the roof, I kept saying over and over again, because, occasionally I can be like a broken record, that thank God we have Prop 13 here. But in other states, what in the hell is going to happen once those people start getting their adjusted tax bills, right? What I didn't know at the time, and we have since learned, is that every state is different. So some do, or counties, some do it every year, some do it every 4 years, some do it every 5. So imagine that you live in a state that does the reassessment every 5 years and your property value just went up by 30% or whatever it's been. You are so toast if you're on a fixed income or anything else. And again, the government is not saying, oh my God, let's address this affordability crisis and let's, cut our property taxes. That's never going to happen. They're
What?
never going to agree to anything. I know. Call me
What I was
cynical.
saying was, we're not talking about the assessment of property value, right? We're talking about that there were extra costs, right? that the tax collector just didn't bill in a timely basis, right? If they're not going to bill the consumer, homeowner, investor that owns property, whatever, in a timely manner, then they shouldn't be able to collect the money. So it is possible to get that done. Actually, right now, with the midterm elections coming up right now, if DC actually asks for a bunch of states to show up for certain conversations regarding affordability and other things, they would absolutely show up, especially the senators and congressmen, et cetera, because if they didn't, they would be headline news during an election season.
Yeah, I think it, yeah. Okay, I had a feeling when we got before we started that we were going to run out of time before we ran out of things to talk about. So I want to cover a few of the things in the chat really quick. So somebody asked, Jennifer, did you ever find it a challenge to balance creating a performing, profitable fund with the needs of a family owning only their residence, since you have a perspective from both ends?
Define your version, Peter, of fun.
Well, probably some of the, when you were working at the banks or those places, when you were putting together different plans.
So, a family owning primary residence, most of Wall Street would prefer to own primary residence collateral, which is why I asked him the question that I asked. Right? So, no, we would not have a problem with high saturation performing primary residence collateral. As a matter of fact, you'd pay more for it.
Okay, so the other question is, if they get privatized, the GSEs, I'm assuming, will there be even more incentive to keep the cash cow fat?
It depends, right? It depends on what happens with them, how they're offered. Are they actually going private? And, the stock being bought out, turning them to mortgage companies, which I don't think will ever happen, right? But it really depends on how. Right now, they don't want to end the cash cow thing because if they ever do decide to IPO them, which by the way, they are technically already public companies, they're just currently delisted. So when everybody says, "Oh, we're going to take the GSEs public," that like happened already, right? But to put them back and be relisted and bring additional investors back to the table to buy let's call it common share stock in those entities would be what the offering really is. It all depends on how it's structured. If you're Ackman, who owns a ton of prior stock from pre-housing crisis days and has held on to it, you want to have that entity be offered in a big way so that at a high price for that stock and valuation. And to get to that higher valuation, it's performance, it's production, it's cash. How much money can I make in this entity? So they're not going to be so quick to peel back the onions. One of the reasons why when I addressed the G fee, I didn't say this thing should really look like X, which is like half of what it is, because they're going to want to keep that additional basis in the entities if they're going to look for that additional investment down the line.
I think we can't sit around expecting the government to do what's right for anyone other than their bottom line. Okay, not to be, again, cynical, but somebody made the point. Remember Greenpoint Mortgage? The three things we'll never ask: what's your sign, what's your shoe size, what's your income? Oh my God, thanks, Jenny, for that.
Make a good throwback on that one. I can actually see.
Oh my God. Just like Countrywide, remember that? The if ever somebody wanted to like slam a file through that was questionable, they would send it to Countrywide towards the end of the month when they were trying to hit their numbers. And the motto was, oh my God, what the hell was it? It was fund it. Oh, F it, fund it, fix it later. That was it. F it, fund it, fix it later. So,
I had one of those at Countrywide where they funded a loan I hadn't even fully submitted yet.
Yeah.
Like, what do you mean you funded? We're not even at docs.
Are you serious? Holy smokes. Okay, Jen, in 2 seconds, approximately, can you walk us through the credit? You had mentioned credit. That was one of the other things I wanted to cover. The bureau, the change, all that. The Vantage, the FICO 10T. What are we doing? Oh my God.
I don't know if that's a 2-second conversation,
it's
but
not,
high
I
level,
know.
Credit modernization was brought forth so that the models would use additional data components than what was being used historically. Vantage 4 and FICO 10T were approved as replacements to FICO Classic. but the manner in which they were supposed to be rolled out was side by side. Vantage 4 and FICO 10T were supposed to go live side by side. They then were supposed to require the GSEs bi-merge credit reports for each of the two scores to be compared side by side to FICO Classic for a period of time that was never really defined with an end date. The purpose of that was so that FHFA, Fannie, Freddie would have all three component parts. Classic, which is what the market's been using for over 25 years, Vantage 4 and FICO 10T, so that they could then use that data in order to create a calibrated LLPA grid. Insert the current administration. Lender choice obviously does not provide you with that data. Putting Vantage 4 in, pilot without FICO 10T side by side and allowing lender choice to only deliver loans with Vantage 4 isn't really providing that look through to, the GSEs. So we now sit in a place where we're probably going to end up with multiple LLPA grids for multiple entities, right? And that means anybody that uses more than one scoring model, not just Fannie and Freddie. What I will tell you is we have done a significant amount of analysis on this, and there are very big differences between the FICO Classic model to the new credit scoring models. What I would say is FICO has done a good job keeping a similarity to the baseline of Classic and then enhancing it with trended data, whereas Vantage is kind of like throwing the baby out with the bathwater and started with like a totally different methodology. FICO, for example, will only create a score when you have 6 months of data reporting on a trade line. Vantage will create a score when you have 1 month. Well, I think we all know that generally when a trade line opens, no payments are made in that first month. So I'd like to understand how they're coming up with, a credit score that can predict possibility of default without any payment information in those instances.
Listen,
So there's a
Jennifer, come
lot
on.
of details to dissect.
I mean, details, really.
Yeah.
I mean, is that really important?
I mean, I don't know. Knowing if, the consumer actually makes a payment on their debt probably is really important, especially seeing as we're creating debt that requires payments. Just saying, right? So
Listen,
there's a lot of
maybe their
nuances
cell
there.
phone payment is on their credit report. That tells you everything. It'll be fine.
That's what she said. like,
Oh my God. Okay. Well, I already have a lot to talk about next week because we did not get to everything this week, just as I anticipated with you. So with that, we really appreciate you today. It was very interesting. You have such a depth of knowledge. It's fantastic. And to everyone, there are loans. We are busy. Thank God we are busy. There are loans out there. You're going to have to work your tail off. But remember what we discussed with Paul Hinman a few weeks ago. It's not a file, it's a family. And we remember that because we live it every day. So go get a loan, work your tail off and get it funded and get someone into a home or make their lives better. So with that, have a wonderful week. Thank you, Jen.
Thanks for having me, everybody. Have a great
Jennifer.
day.
Bye.
Bye.